Hey everyone, welcome back to another dividend investing video. I don't know about you, but I love collecting passive income, and real estate is one great way to generate some cash flow. Personally, the idea of being a landlord has never appealed to me, but luckily, there is a way for investors to get exposure to fantastic real estate, and this is via real estate investment trusts. These act just like ordinary stocks and allow you to buy ownership in real estate without needing a down payment or making mortgage payments or the hassles of being a landlord, right? REITs are one of my favorite investment vehicles, and a lot are ideal for dividend growth investors. Today, I'm going to give you an introduction to 3 REITs I think are seriously undervalued at this time and warrant a spot on your watch list. And these are a little more under the radar than a lot are often talked about. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Now, before I share the REITs I've chosen, I want to establish some basic criteria I've used for my selection process, okay? I want the price to adjusted funds from operations to be lower than the 5-year average. And remember, REITs, we use price to adjusted funds from operations, P to AFFO, instead of PE. P to AFFO is a more accurate way to value a REIT. Price to earnings is pretty meaningless. Next, I want a dividend yield that is greater than its 5-year average. The yield itself is not a huge consideration, but more that we're locking it in for a better than average yield for this particular company's own track record. Third, the dividend is covered by adjusted funds from operations, and since I pay the hefty price tag for Simply Safe Dividends, I'm going to use their safety score as a guideline. We want our investments to be rated safe or better, and that is a minimum score of 60. Fourth, I want a dividend growth track record of at least 7 years. And finally, the most recent dividend raise was 10% or greater. I'm looking for REITs that are growing these dividend payouts by double digits. That's important to me. And again, let's establish that I do not want to chase high yield. Generally, the higher the yield, the less growth we're going to see, both to the dividend and to your invested capital. And also, before investing in REITs, make sure you understand the tax implications that come with owning these companies. These can make fantastic dividend investments, but their dividend payments are non-qualified, meaning they aren't taxed at the rate of your standard qualified dividends, which do get some special tax considerations. Dividends from REITs are taxed as ordinary income for whatever your own tax bracket / situation may be. As I always say, I'm no financial advisor or professional, so just make sure you're doing your own due diligence in terms of taxes. With that said, let's get into it. These are 3 high-quality REITs that are looking undervalued and appealing at the time of publishing, with a positive outlook. I'm releasing this video in mid-April of 2023, so if you come across this a few months after the fact, maybe check out my channel for a more recent video, because I put out a video like this every quarter or so for my top picks in real estate. And also, stick around until the end. I will briefly review a couple other REITs I think look quite compelling right now, but they either don't meet all of my criteria or I might have reviewed them recently. So let's do this. The first REIT I'm going to talk about is EastGroup Properties, ticker EGP. EastGroup Properties is a member of the S&P Mid-Cap 400 and the Russell 1000 indexes. EGP is a self-administered equity REIT that is focused on the development, acquisition, and operation of industrial properties, specifically in Sunbelt markets throughout the United States, in places such as Texas, Arizona, California, North Carolina, and Florida. They provide business distribution space for location-sensitive customers. Their strategy for growth is based on ownership of premier distribution facilities, generally clustered near major transportation centers. Notice they're in all the fastest growing markets of the country, which has a lot of appeal if you're looking for a company that can continue this kind of growth that they've been experiencing. Year to date, shares of EGP are actually up about 8%, and this is a little bit better than the broader market, so they've been doing pretty well. However, over the last year, shares are still down over 20%. And like many REITs, EastGroup dropped dramatically in the year 2022. And looking over things, I think that was a bit of an overreaction. This is a pretty solid company. EastGroup Properties forward price to adjusted funds from operations is 27.3, and this is about 11% below the 5-year average of 30.8, meeting our first criteria. EastGroup Properties shares can be obtained at a 3.14% yield, or a yield of roughly pi. That tasty yield is 25% above EGP's 5-year average yield of about 2.5%, easily meeting our second criteria. EGP's adjusted funds from operations payout ratio is at 85%. This is edging a little high, but typical for this type of company. And remember, companies that are these REITs are required to pay out 90% of their funds back to investors. And with the simplysafedividends.com safety score of 73, rated safe, this meets our third criteria. EGP has been paying this dividend uninterrupted for 28 years, and for the last 11 has been growing their dividend, meeting our fourth criteria of at least 7 years of dividend growth. And their last dividend announcement saw their payout go up by 14% just last August, easily meeting our final criteria of seeking double-digit dividend growth. The non-qualified dividend is made in quarterly payments in the amount of $1.25 every January, April, July, and October, and the total annual payout is at $5 per share. Now, EGP displays the kind of revenue growth we want to see in an investment. It's more than doubled its revenue over the last decade, going from $202 million in revenue in 2013. In the last 12 months, they've brought in $487 million. This is still a mid-cap company with a market cap just above $7 billion. I think there is still plenty of room to grow here. EGP is covered by 14 Wall Street analysts who overall give it a buy rating 3.64 out of 5, 5 rated a buy, and 9 a hold. The average price target for EGP is $173.69, representing a potential 9.2% upside from where we are right now. Couple that with a 3% yield, and we're looking at a potential 12% return. I think of East Group as an alternative to the more popular STAG Industrial, ticker STAG, which doesn't really fit my own investment objectives, but it's very popular. Their dividend isn't nearly as safe, and their dividend growth is practically non-existent. While East Group looks to be in a far better run business, but because they don't make those sweet monthly payments, they're not as popular. But I think East Group Properties is the better company and deserves a spot on your watch list. Real quick, my friends, I'm sure many of you are using the popular website Seeking Alpha frequently, as I do for much of my own research, both for my own investing and for the content on this channel. And they offer a ton of great information for free. But if you're interested in taking things to the next level with Seeking Alpha, I have partnered with them to bring a 7-day free trial membership of their premium service so you can try it out and see if you like it risk-free. And if you decide you want to keep the membership, you'd only pay $99 for your first year. This comes out to a little more than $8 a month, and I think that is an excellent value for what they provide. Lots of great articles from wonderful authors alone is worth it in my opinion. And you can only get this deal by using the link in our description, so please consider checking that out. It's a great way you can help support the work here on our channel. Okay, our second REIT we're featuring today is Mid-America Apartment Communities Inc., ticker MAA. MAA is an S&P 500 REIT based out of Memphis, Tennessee that invests in apartments in the southeastern and southwestern United States. As of December 31st of 2022, the company owned over 300 apartment communities containing over 102,000 apartment units. It's the largest owner of apartments in the United States and the 7th largest apartment property manager in the US. Investing in MAA is owning a piece of gorgeous luxury apartment properties and collecting quote-unquote rent checks in the form of dividends. This is another one where I love the locations they are targeting. Growing metros like Tampa, Charleston, Nashville, and Phoenix. And their plan is to expand in the markets of Atlanta, Denver, Orlando, Raleigh. These are prime locations, prime fast-growing communities. Mid-America Apartment Communities is down a little over 5% year to date. The slide from 2022 has continued into this year for these guys, and the share price for MAA has seen a major dip down over 28% in the last year. This could be either a value trap or a wonderful opportunity. So let's dig in and see if it meets our criteria and is a healthy company worthy of investment. In terms of valuation, MAA is trading at a P to AFFO of 17.8. This is a near 17% discount to the 5-year average of 21.4. First criteria, check. MAA's dividend yield today is at 3.8%, which is quite appealing, and it's also 19% above the 5-year average of 3.19%, easily meeting our second criteria. Nice. Now, how healthy is this dividend? It takes up 68% of adjusted funds from operations, and as mentioned earlier, REITs get the flexibility of having high payout ratios due to their nature. I would call this a very low payout ratio for this type of company, which bodes very well for future dividend growth prospects. SimplySafeDividends.com assigns it a safety score of 97, seeing it as very safe as things stand today. Criteria 3, check. I'm also looking for at least 7 years of dividend growth. MAA has 12 years, and that comes with 28 years without a cut. Looks like it spent some time basically static, but in the last decade they've shown a commitment to raising their dividend and have raised their revenue in such a way that has allowed them to grow their dividend. Criteria 4, check. And their latest dividend increase was announced back in December at 12%, meeting our fifth and final criteria. We want that double-digit dividend growth. Now, 10% plus dividend growth is new for this company. They've typically grown it slower, but I'm liking what I see with the fundamentals and believe that they are set up in a way they can continue growing this dividend at this type of rate. MAA's dividend is paid out on a quarterly schedule. The non-qualified payment of $1.40 is made every January, April, July, and October. Notice they've raised the dividend a couple times in the last year, and I'd like to see this trend continue. The revenue has been growing consistently year over year this past decade. In 2013, they brought in about $640 million in sales, and in the last 12 months, they've done over $2 billion. MAA is covered by 22 Wall Street analysts, and the vast majority rate it as a hold. 6 is a buy, 14 is a hold, and 2 a sell. But the price target is more optimistic on this one at $174.29, representing a potential 18.52% upside from where we are today. And for what it's worth, most of the authors on Seeking Alpha who have been writing articles about this company seem to love this pick and overwhelmingly recommend it as a buy. MAA seems to be executing and doing all of the things right, particularly from the perspective of a dividend growth investor. Is this one that you own? Let me know down in the comments. What is a REIT that you've been buying right now? And if you aren't buying any REITs, what's on your watch list? The third REIT on our list is Rexford Industrial Realty, ticker REXR. Rexford Industrial is headquartered in Los Angeles and is focused on owning and operating industrial properties, particularly in the Southern California market, with over 232 properties and 27.9 million rentable square feet. So this company is very similar to East Group Properties, which we went over early in the video, but these guys are just focused on Southern California, which is in itself a larger economy than many individual countries, and they're actually a larger company than East Group. But they're also a newer company. They were established in 2013, but in that time, they've grown to over an $11 billion market cap. Year to date, shares of Rexford are down just above 1%. It hasn't moved a whole lot in that time. However, in the last year, Rexford Industrial is down almost 30%. And at the time of publishing, shares are only a few bucks above that 52-week low. REXR trades at a price to adjusted funds from operations of 3.19, trading at a 19% discount to its 5-year average P to AFFO of 39.4. Criteria 1, check. Rexford Industrial shares are available at a dividend yield of 2.76%, so this isn't a high yield, but respectable, especially considering this is 45% above the 5-year average of 1.9%. We should make sure the fundamentals are healthy otherwise, but this checks off criteria number 2. Now, the percentage of adjusted funds from operations paid out in dividends is 88% for the next 12 months. It's a little on the high side, but still below the 90% threshold we want. And yes, we want this number to be below 90% for REITs. SimplySafeDividends.com gives us a safety score of 81, rated very safe, meeting our third criteria. Rexford Industrial has only been around for a decade now, but have been growing their dividend every year since the beginning. That's 9 years of dividend growth, meeting our fourth criteria. And check out that latest dividend raise that was announced back in February at 21%, meeting our final criteria, seeking dividend growth at double-digit rates. And note the 5-year average annual dividend growth rate is 17%. As with many REITs, the payout schedule for REXR is January, April, July, and October quarterly, making a non-qualified payment of 38 cents per share for an annual payout of $1.52. This is a company that started out with $44.3 million in revenue in 2013, and in the last 12 months brought in $631 million in revenue. I'd say they're off to a fine start, and look to just be getting started. Rexford is covered by 9 Wall Street analysts, 5 rated a strong buy, 3 a buy, and 1 a hold, for an overall rating of 4.44 out of 5. Small sample size, but impressive. The average analyst price target is $70.13, representing a huge 30% potential upside from current price. No forecasts see this stock being lower a year from now. Rexford is an under-the-radar REIT that has delivered huge dividend growth for investors in the last decade. As a fairly new company, they lack the track record of some of the others available, but with that comes considerable opportunity for growth, probably the more higher risk-reward play out of the group we're talking about today. Now, folks, I couldn't cover everything here. It's on you to do the rest of the due diligence. But let's wrap this up by going over a couple more REITs that I think are at a compelling place. The first is VICI Properties. It lacks a track record to meet the criteria, but checks so many other boxes. And I own this one in my Roth IRA. And if you've been following my Roth IRA series, you already know this is the stock I've been buying in 2023, and I'll continue to do so. VICI owns a large share of the towering resorts that line the Las Vegas Strip. Investing in VICI to me is betting on American tourism as well as gaming and entertainment. And I think the Simply Safe Dividend Safety Score of 50 is perhaps too conservative, considering this company went through a pandemic when all of its customers were forced to shut their doors, yet every one of their customers met their rent obligations in that time frame. VICI's popularity has soared in recent months in dividend investing circles, and who wouldn't want to own a piece of those properties? The second is Realty Income. While the dividend raises from O do not grow at a rate that meet the criteria of this video, they are perhaps no more reliable dividend paying REIT on the market than the monthly dividend company Realty Income. I recently bought some at the end of March. This is one I'll continue to buy whenever it's below my own cost basis of $65, and it's particularly appealing when it's above that 5% yield, which is when it's below $61. There is something amazing about those consistent monthly dividends. You are sacrificing some dividend growth for reliability, but I think this is one that just about every dividend investor ought to have some exposure to. I think of it as the Johnson & Johnson of REITs, if you will. And finally, I still like American Tower REIT, and I think they fit all of my criteria, but I highlighted them in the last video in this series, so I'll just mention that this one still looks fantastic. Their single suite multi-tenant model is excellent. And these folks are so serious about dividend growth that they're displaying a major commitment to dividend-minded investors by increasing the dividend payment every single quarter. That's correct. Every payment from American Tower is bigger than the last. Hey, if you are still here, you are my people. I appreciate you so much. Please do me a favor and hit the like button, subscribe. The algorithm has been shitting on me lately because I haven't been posting as consistent back in March, but I'm working on a comeback. And if you want more, I encourage you to check out these 4 stocks I think are attractive for the month of April 2023 and into Q2. I hope you have a wonderful day. And until next time, keep investing.